All right, we're back. I got interrupted there. Pardon me for that. But I think you got the picture of what the tax law of Subpart F is all about. It's trying to capture the tax avoidance issue of monies being diverted from the country of incorporation, the foreign country of incorporation, into other countries, which might have higher tax rates, but by putting everything into this one foreign country corporation and holding up U.S. tax through only when dividends are paid. That's the concept, and maybe this introduction will help understand the nuances of Subpart F. So having said that, let's start seeing what some of those nuances are. All right, so this is going to help us, I believe, very well with the introduction we've had, which is the U.S. owner does not report income earned by the foreign corporation, as that income is deferred from U.S. taxation until repatriated as a dividend. There's that word which I was hoping you picked up on, the concept of repatriation, and that's only meaning it's taxed in the U.S. It hasn't been taxed up till this point. Until it's paid as a dividend, it hasn't been taxed in the U.S. in this concept of where you have a foreign corporation. When you have what we call anti-deferral, that's another way for tax avoidance. Deferring taxes is one thing. Having a setup where you can defer taxes for a long, long period of time without economic hindrance, because you're using the money in a foreign country where you're doing business and you're just building up the operations, holding that captive in that foreign country, so to speak, becomes maybe a little bit stronger than just deferral to the word anti-deferral or tax avoidance. All right. So Subpart F applies to what we're going to learn some words. Certainly we've already learned this concept of calling it Subpart F. That's the area of the tax law we're talking about, and in particular it's going to apply to what's going to be called a controlled foreign corporation. So the issue of the type of picture that we drew here, where you have this foreign country corporation holding back paying the dividends, that's going to apply when we have something called a CFC, controlled foreign corporation. If we don't have a CFC, Subpart F will not apply. So what is a CFC? It's a foreign corporation, obviously, and it's one where on any day during the year, the U.S. shareholders own more than 50% of the combined voting power of all classes of stock, or more than 50% of the total value of the foreign corporation. Okay, so that gives us an idea that in order to be a controlled foreign corporation, U.S. shareholders are going to have to be the majority owners, more than 50%. The definition of what is a U.S. shareholder is going to be what comes next. Let's see if the slide does it. If not, I'll explain it. Because the concept of U.S. shareholder is not what you think. It's not just anybody, but it is, in particular, a U.S. shareholder is defined as, under Subpart F, this is only for Subpart F, is a U.S. person owning at least 10% of the total stock of the foreign corporation. At least 10%. And of course this applies, this paragraph is to let you know that direct or indirect ownerships, constructive attribution rules, which we don't get into in this course, that's a concept you should have been introduced to through the first tax course or the entity tax course, basically means that you can't avoid the 10% by having parents and children own part of the stock, or maybe even a related corporation. You can't spread the stock ownership out in order to make everybody less than 10%. So staying with the 10% rule, the idea is that the concept of a shareholder, remember we got to get to U.S. shareholders owning greater than 50%, that's the goal. It's got to be greater than 50%, but the only shareholders that we're going to count towards that 50% rule are the shareholders owning at least 10%. This is a continuation of the attribution rules of direct or indirect, so we can skip over this. And this really brings home the whole point that if you have one U.S. parent owning 100% of a foreign subsidiary, it for sure is a CFC. Why? The U.S. parent is a greater than 10% shareholder. Is it greater than 10 or equal to 10? At least 10. So it's greater or equal to 10%. So the parent owns at least 10% or more. In fact, and that U.S. shareholder, once we now know that it is a U.S. shareholder, that it owns more than 50%. So let me go through that steps again to try to just clear that up. In fact, let's do the following. Let's clear the drawing board and go through it one more time. Concentrating on this statement. If you have a parent company, step 1, is it a U.S. shareholder? Well, the foreign corporation that it owns, let's say, 100%. As it says here. If it owns 100%, the first question is question 1. Is it a U.S. shareholder? What's a U.S. shareholder? Owns 10% or more. I think I wrote that the wrong way, didn't I? It's greater than or equal to the 10%. So is it a U.S. shareholder? Answer, yes. Now, do U.S. shareholders own more than 50% of the foreign corporation? So that would be step 2. And step 2 would say, does it own more than 50%? Has to be more than, not equal to. So more than 50%. And the answer is going to be yes. Why? It's only one. It's the same shareholder. It's the same shareholder. But the 2 steps still have to be answered in the decision tree of, do we have a CFC? So now what we've got is a situation where take these 2 together, both are yes, so the foreign corporation is a CFC. It's a controlled foreign corporation. Here's an example. We have a U.S. shareholder here owning 26%. We have a non-resident alien owning 48%. And then we have GW here, which we'll label being another U.S. shareholder for the time being. And let's start with the illustration where it's another shareholder, and it owns 26%. So step 1, let's do it again. Step 1, do we have U.S. shareholders? Yes, we do. Who are they? Well, they're this guy, we'll call him number 1, and number 2. They're both U.S. shareholders. Do collectively, step 2, do they collectively own more than 50%? And the answer is yes, because it's 52%. And therefore, Forco, this case is foreign corporation, Forco is going to be considered a CFC, controlled foreign corporation. Now, the fact that we have a controlled foreign corporation still doesn't mean we have subpart F income to deal with, but the first step is, do we have a controlled foreign corporation? Now, the next step will be, do we have subpart F income? Before we go to that point, let's just make mention of one true fact, and this a couple true facts. First of all, if you have a U.S. company, which is, or U.S. people, you have a foreign corporation, let's say you have a foreign corporation, and U.S. shareholders, these are all U.S. shareholders, each one of them is unrelated, and each one owns 1%. So they're unrelated, and each one owns 1% of this foreign corporation. So you do the math, do this decision tree. 1, do we have U.S. shareholders for purposes of subpart F? Yes, we have U.S. shareholders, but how about for the definition of subpart F? And the answer is a flat no, because none of these people up here own 10% or more. So they're not even considered in the equation. So if you go to step 2, we don't have anybody owning greater than 50% because we don't have any U.S. shareholders, according to subpart F. Yes, they're all U.S. shareholders, but they each own less than 10%, so they don't even get counted in the decision tree as to whether we have a CFC. That brings up let's go to I didn't have it here, so let me do it for you. Brings up a really actually it's kind of fun for me to do it for you. Brings up a really interesting planning point where if you do have a parent company, U.S., owning a foreign corporation in a foreign country, obviously, then if you set up this foreign corporation such that no one U.S. shareholder owns 10% or more, because that's the rule, everybody owns, let's say, 9%, So you deliberately set up the ownership of this corporation to have, instead of just one owner, you have 11 owners, and each one owns less than 10%. So let's say 9%, that would be the number. 9% would be the number, or 9 in a fraction. You would get up to 100% ownership, but nobody counts for CFC purposes, because the only way you count is you first have to be a 10% or greater owner. So all the 9% owners don't count. Put all 9 together to see if you're greater than 50% ownership of the company. Sure, you are, but that step doesn't even get there. You don't even have to do that step, because they're not considered U.S. shareholders for purposes of Subpart F. So the way it would work, again, in this situation where you have 11 owners and they all own 9%, is there is, at this stage, there is no U.S. shareholder for Subpart F purpose. Again, yes, there are U.S. shareholders by our normal discussion of who the shareholders are, but not for Subpart F. So you're done. So that's sort of the gimmick. Not that companies can make use of that gimmick oftentimes, because ownership is something that it can't be related parties. It'd have to be all unrelated parties. Otherwise, the rules of attribution would apply, and the related party rules get rid of somebody trying to deliberately set it up where there's a bunch of less than 10% shareholders, and yet it's really all benefiting a couple of people in a way that would make them more than 10%. So the result is that this gimmick can be done, but it would have to be done with unrelated shareholders. Okay, so I think that takes us through what a requirement you have to have first in order to know whether you even have a Subpart F income issue. Is first you have to have a CFC. And we've gone through the definition now in detail of what constitutes a CFC. If you don't have a CFC, Subpart F doesn't apply, you're done. If you do have a CFC, now you go to the next step, and that is, do you have Subpart F income? That's the whole question. Do you have Subpart F income? If you do, that's going to be subject to current taxation. If you don't have Subpart F income, you got no issue. So we're going to go through the categories of what's called, I used this term before, tainted income. Look how it's written: derived by a CFC, controlled foreign corporation. So you must have that first. And the definition that we're going to go through the most will be concerning what we call foreign-based company income. Foreign-based company income. But you'll see that as we go through. So what we're about to do again, to set up the scenarios, we're about to now to go into what constitutes Subpart F income. We'll stop there, and that's what we'll pick up next time.